What's up, guys? This is part two of the video series where I go into detail on the concepts that are being discussed inside of this PDF, right? So, before we go ahead, just pause the video and read the risk disclaimer, knowing that trading carries risk and the concepts that are discussed are not indicative of future price results, and you are responsible for your own trading, as trading is risky and you should acknowledge that risk. Now, let's recap. In the previous video, we talked about how price will run above highs, taking out the stops in the form of buy side liquidity, and the market makers would use this as an opportunity to sell because that's how they are able to enter the orders. The same way we can say that the sell side liquidity is tagged and price reverses and price trades higher because the sell side liquidity is then taken. Market makers buy from those sellers and they're able to ride the market up. Now, in this video, we are going to discuss an entry technique that we can use to be able to know that price will reverse from here, or one of the things that we will know, as there are other confirmations as well, but this is one of the confirmations, right? So this is the market structure shift entry technique. So the first thing that I would like to say is that the market does not reverse without taking a stop loss. Okay, so as you can see over here, the market is trading down. It's not suddenly going to start trading up. It first has to take out a low, which is someone's stop loss, and then it will reverse, right? So the way we know that the market will reverse is that we are going to look for an entry over here, right? So on the lower time frame, inside of this level that we've marked here as our sell side liquidity, there is a lower time frame entry, right? So let's look at this lower time frame entry. Now, the first thing that we are going to discuss is a swing high formation. A swing high formation is very simple. It is a 3-candle pattern where we look to the left of the candle. This is candle number 1, this is candle number 2, and this is candle number 3. Candle number 2, if we look to the left, we see that this candle, the high, is lower than candle number 2. And if we look to the right, candle number 3, high, is lower than candle number 2, making this a swing high, okay? So the entry technique we use is when price goes here to this level, we go down to a lower time frame, such as an M15, M5, M4, M3, M2, M1. That's like 5 minute, 4 minute, 3 minute, 2 minute, 1 minute. We go down to those time frames and then we look for an entry. And the pattern that we look for is 2 of these, right? It can either be one or the other. It's either the market trades lower, then the market retraces a bit and then trades even lower than this previous low, and then it trades up. It trades above a swing high, okay? So this area right here is a swing high. The market trades above it. When the market does that, after taking the stop loss over here in this level, when we see this pattern form on the lower time frame, that is an indication to us that the market wants to reverse, right? So over here, we can see this is a swing high right here. This red level that I marked is this stop right here. Can you see that? We're just looking at it from a lower time frame, okay? So we've ran the stops over here. Now we're below it, right? What you want to see is that price breaks a swing high as discussed over here, right? And if you look closely, This is the swing high because we look to the left, we have a candle that is lower, the high is lower than this candle's high, and we look to the right, we see that the high of this candle is lower than this candle's high, making this a swing high. That's why I put that little light bulb there, right? So when price trades above it impulsively, we know that that is a market structure shift, okay? So this is an indication that the market has changed its direction. The market was once moving bearishly lower, and this over here is the confirmation that the market is changing from moving bearish in sells to now moving bullish in buys. Okay, so once the market trades above here, the market will simply just retrace a bit lower. It will not go lower than the low that was formed prior to the market structure shift. So the market will simply just retrace and continue trading higher. Can you see that? So this is how we are able to get that confirmation that the market is turning. Now, the way we enter is we are going to look for what we call a fair value gap. Okay, so a fair value gap is also a 3-candle formation. Just so you know, the colors of the candles don't matter, can be any color, but what you want to see is that, okay, over here this is candle number 1, this is candle number 2, and this is candle number 3. If we look at the low of candle number 3 and the high of candle number 1, they do not touch one another. That's why we call it a fair value gap. Okay, so this gap in the high and the low between candle number 1 and candle number 3, we can see that it is encapsulated in candle number 2. There is a gap between them. Therefore, this is a fair value gap. So with fair value gaps, when you are bullish and you have a bullish fair value gap, in this case, price will usually trade back into the fair value gap and then trade higher. Okay, so over here we can see that once we do the market structure shift, or we break market structure by trading above the swing high, we want to see a fair value gap form. And as you can see over here, the fair value gap has formed. Price trades back into the fair value gap. Then, as you can see, price finds support at the fair value gap and trades higher. Okay, so that is what you need to see. And as you can see over here, this is just a depiction of the trade where you would place your stop loss below the low that was formed prior to the market structure shift. You just place your stop loss there, and price trades into the fair value gap, doesn't hit your stop loss, and it goes in your direction. Now, this is a sell scenario. It's really the same thing, just reversed. So over here we can see we have buy side liquidity. As you can see, the market was trading lower until it came back up to take people out of the trade. That's how the market makers operate. And on a lower time frame, we will look for the entry pattern to form when it does this, right? So we can see that this blue line over here is the buy side liquidity that we marked there. We're only looking at it from a lower time frame. Okay, so what we can see over here is that we tag the buy side liquidity and we have what we call a swing low formation. It's just the reverse of a swing high, where we see that we have candle number 1, candle number 2, and candle number 3. The low of candle number 1 is higher than the low of candle number 2, and the low of candle number 3 is higher than the low of candle number 2. This is what we call a swing low. So when we have a swing low, as you can see over here, we have a swing low that formed after we've ran the buy side liquidity. We want to see price impulsively trade below that swing low, that is a bearish market structure shift. Over here, this was a bullish market structure shift, right? But in this case now, since we're looking for sells, this is a bearish market structure shift. So the market trades below it, right? And then we will expect price just to retrace a bit and eventually trade lower. Now, we are looking at the bearish fair value gap, and it is also a 3-candle formation where we are anticipating sells. Again, the colors of the candles don't really matter. It can be a bullish candle, it can be a bearish candle. The formation is what matters. Okay, so as you can see, we have candle number 1, candle number 2, and candle number 3. The high of candle number 3 and the low of candle number 2, they don't touch one another, leaving this gap in candle number 2. This is why we call it a fair value gap. It's fair value if price returns back to it, because it's a opportunity that we can use to sell when the market moves back into it. So once we have our break or shift of market structure right here, where price trades below that low, right? And then we form the fair value gap. As you can see, this candle is a bullish candle, while this one is a bearish candle. So the colors of the candle don't matter. It's the 3-candle formation. As you can see, the low of the candle and the high of this candle is inside this candle, which would be candle number 2. Candle number 1, candle number 2, candle number 3. Fair value gap. So as you can see, once price breaks structure and we have that fair value gap, we can place our order inside the fair value gap and wait for price to get back inside it. As you can see over here, price trades into the fair value gap, and it does trade into it again, but eventually it trades lower, as you can see, right? So that's the fair value gap. And as you can see, this is a trade recap of how the trade would have gone. We have the run on the buy side liquidity, shift in market structure when it trades below the swing low, and then we form the fair value gap. Price retrades back into the fair value gap, and then it trades lower, as you can see, right? Even over here, there was another fair value gap. Price trades there and trades lower. Here there was a fair value gap, but you don't want to trade fair value gaps that are very low. Like if you take this high and this low and you had a fib, you would see that this fair value gap is in a premium, so you would have used that fair value gap. But that's another topic for another day. As you can see, this video is the entry technique. We're going to go into more confirmations that we are going to know that when price reaches here, it will reverse, because that's not the only confirmation you need. We need just one more confirmation, and we will discuss that in the next video. Okay, so have a lovely day. Rewatch the video if you don't understand. You can also comment if there's anything that you don't understand. I will be answering your questions. Thank you very much. Talk soon.